I'd been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. I was taught that, we'll say in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly cigar, one puff left in it. But you pick it up and you get your one puff, disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money. Time is the enemy of the lousy business. Staying with those kind of businesses is a big mistake.
This is one of my favorite Warren Buffett talks. He has said his style of investing has been affected by three different people: Benjamin Graham, his teacher, the father of value investing, and the writer of Intelligent Investor and Stock Analysis. And the other two are Charlie Munger, his friend, and Philip Fisher, the writer of Common Stocks and Uncommon Profits. You can find the link to these books in the description. I highly recommend reading these three books. I talked about the same topic in the introduction video, that it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buying fair companies at wonderful price needs lots of work, diversification, and it's not that much scalable, as Warren Buffett said, and time is your enemy. But for a wonderful business, time is your friend. Here we have two tables that we will fill with data, and you will see what we mean by time is the friend of wonderful business. So without further ado, let's get this video started. Hello and welcome. Let's imagine that you have a company that has an income of 600 million and is being sold very cheap with a PE of 5. So right now it's worth $3 billion. Since it's a fair company, it will grow its income with the same rate as inflation. So next year you will have 600 multiplied by 1.02. And let's imagine it will do that for the next 30 years. Let's imagine for the first 10 years it will be traded at the same PE ratio of 5, and then suddenly it will go even overpriced to a PE of 15 and stay there for the next 20 years. So now after 30 years, it's now worth $16 billion. So you have multiplied your investment a little bit more than 5 times. Not too bad. So you bought the company at the cheap, and now you can sell it at a higher multiple, and it has grown its income with the same rate of inflation. Now let's do the same calculation for a wonderful company. Let's imagine first year they have 100 million income, and they're being sold at a PE ratio of 30, which is a little bit overpriced for them. But since they are a wonderful business, they can grow their income every year by 10%. And let's imagine they can do so for 30 years. And for the first 10 years, we will keep the 30 multiple, but then for the next 20 years, it will be at 20, which is a little bit fair for the company with this growth. Now you can see after 30 years, the valuation of the company would be around 32 billion. So they both started at 3 billion, but the wonderful company ended up twice as high, even with the multiple going down. So here we can see that time is a friend of a wonderful company, but enemy of a mediocre one. Even with the multiple going higher 3 times and the multiple for the wonderful company going down, you have grown your investment 2 times more. Charlie Munger says if you find 3 of these companies, buy them and let them compound, you are set for your life. But for fair companies, you need to buy a lot of them at the right time, because some of them will go bankrupt to be able to make some money. If you can pick the correct time here between year 10 and 11, you could have tripled your money very fast, but this is a very hard thing to do. It's just a guessing game to know when the multiple for a company or an industry will go higher. Stock markets are second order markets, which means you are not guessing what the company will be worth in a year. You are guessing what the other people in the market are guessing what the business will be worth in a year. So it's impossible to time the market and be able to buy these fair companies with wonderful prices at the right time. So it's better to just buy wonderful businesses at a fair price and let the compound interest do its magic. Thank you for watching this video. If you like the videos I'm creating, please consider subscribing to the channel. Share it with your friends. If you have any questions, comment below and I'm happy to answer them. Have a great rest of the day and see you on the next one.